Fed Chairman Jay Powell said that President Trump's tariffs are larger than expected, making it harder to say what the appropriate path forward will be for Fed action. Joining us right now with the tariffs' impact on the Fed is former National Economic Council Director under President Biden, Lael Brainard. She's also a former federal vice chair. And Lael, already this morning we have heard from the president himself posting on Truth Social, once again putting pressure on the Fed to cut rates right now. It's clearly a more difficult position for the Fed to be in. How should they respond?
Look, I think the Federal Reserve is in a bind here. We heard the chair say it, that these tariffs are much larger than were expected. They're going to be much more disruptive. It'll really lead to massive changes in supply chains. And we know from the pandemic that means very persistent inflation or persistent higher prices. Those higher prices could come before any signs of real slowdown in the labor market. And so the Fed is going to have a difficult time. Don't forget, consumers' inflation expectations have already jumped up on the expectation of tariffs. They are coming off the experience of having lived through high inflation, so they're going to be much more sensitive to it. And so the Federal Reserve is going to be very sensitive to any possibility that those inflation expectations could stay higher. And so they're going to be reluctant to provide a lot of support to the economy before they actually see slowing.
Jeff Gundlach pointing out last night that the two-year U.S. Treasury yield, around 3.5%, already is suggesting that Fed funds are about 75 basis points too high, that they would like to see that come back down. This morning, the 2 years at 3.629%. But he doesn't think that the Fed actually will cut rates unless the losses are substantially greater than what we see right now. Would you agree with that?
So I think that it is a very difficult position for the Federal Reserve when you get very strong inflationary pressures coupled with the possibility that the economy could slow a great deal, which is, of course, what the stock market is telling us. Now, the market, as you said, is getting out ahead and anticipating that the Fed is going to have to cut at some juncture. But if those cuts come late, because the inflation comes early, you could still see a very significant downward move in the economy, in the labor market, certainly among consumers. We've already seen their sentiment plunge, and it is likely to go down further as they think about what's happening to their 401ks, as well as the prices they're seeing in stores.
In normal times, the Fed has a pretty straightforward formula. It's going to be looking at things like the labor report. The one we just got on Friday was very strong from a month ago. It'd be looking at things like CPI to try and figure out CPI and PPI, where the inflation levels are. But when you have a crisis like this, the situation on the ground is moving a lot faster than the data will reflect those normal data points that you're watching. Where does the Fed look? What are the alternative data points that they might be reading at a time like this?
Well, I think you're right, first of all, that the last payrolls report, which was good, was backward looking. I think people are expecting the CPI report to be pretty good, but they're not going to take much comfort from it because those tariff price increases haven't started working their way through. But if you look at the increase in the weighted average tariff rate, to something like over 22% from where it is today, that's $3,800 of lost purchasing power for the average family. And that is a very complicated equation for the Federal Reserve to navigate through. You know, it is not even clear right now what those tariffs are going to be. There is so much uncertainty out there. Businesses have pulled back. Obviously, the Trump administration has in mind that they're going to get significant amounts of revenue from these tariffs. So maybe that base of 10% is locked in. That's already a tripling of our average tariff level. And then on top of that, higher tariffs for sectors like auto, steel, semiconductors, possibly lumber. And then we just don't know what's going to happen with the very high tariffs on countries like Vietnam, China, the EU, Europe, and even little Lesotho.
I guess the The Federal Reserve probably doesn't like being put in the position of coming to the rescue for policy moves that are put on so quickly without much time in advance. Is it fair to say that the Fed would be reluctant to jump into the rescue right away?
Well, I think the difficulty for the Federal Reserve is it has to make policy on its dual mandate, which is inflation and the labor market. And if inflation expectations and inflation are moving up quickly, and the slowdown is not coming for some time, they are going to be in a very difficult bind because they are going to want to lean against those inflationary pressures, and that gives them much less ability to come in to support the labor market before they see any signs of weakening. So this is one of the most difficult scenarios for the Federal Reserve, and it's made all the more difficult because the White House has left so much uncertainty, and the markets are reacting to that uncertainty because there is no clarity on what those ultimate tariff levels are going to be. And the tariffs that they have announced are jaw-droppingly large compared to what most people expected and any historical experience dating back all the way to Smoot-Hawley.